Okay, so good morning, everyone. Welcome to the new week. This is the macro snapshot, and we are Monday, May the 19th, 2025. Okay, so the big news over the weekend, of course, well, actually on Friday afternoon, was that Moody's downgraded the US down a notch. So it's no longer at the highest rating. This wasn't a huge surprise because it had been on a watch list for the last year. And keep in mind that already back in 2011, S&P had downgraded the US, and then in 2023 we had Fitch downgrading the US. So of the three big ratings agencies, Moody's is actually the last one to do it. So we had a pretty big reaction, back in 2011 when that downgrade happened. We've had a little bit of a reaction overnight, but it's not the end of the world. And let's all keep in mind that the US prints its own money and can pay its own debt back by printing money. So the chances of US default are zero, essentially. Well, not zero, but are very, very minimal. But therefore, what we have to also think about, though, this is another little sort of shock to the global system that the US is becoming a less certain kind of partner in terms of financial risk. But what's actually also interesting is that Treasury Secretary Bessent over the weekend also said that some of the tariffs, for those would be going back to Liberation Day levels. So basically, he said on an interview on Sunday morning that if countries which were not negotiating in good faith with the US would simply send them a letter identifying the tariff levels they would have to pay. And in some cases, that would be at that Liberation Day, April the 2nd, I believe it was, level, which was very, very elevated. So the point is that we've got just kind of a risk-off sentiment, this idea that maybe tariffs are actually not going to be completely lowered. And I keep on repeating that tariffs, whatever happens with all the so-called deals, that they will be significantly higher than they've been for the last 50 or 80 years. So, but Bessent just reminding us that, some countries would actually still have very elevated tariff levels. And secondly, this Moody's downgrade after the market on Friday has put them, the risk sentiment there's a very sour mood. Okay, so what should happen? Definitely, in terms of the long-term bonds, if you're going to be downgrading a credit, this is not great for the yield curve. And we should have a higher term premium on especially the longer term bonds in the US. So there's more risk. So the term premium, keep in mind the term premium is the extra amount of yield which investors demand to compensate for sort of duration risk. Okay, so rather than just, let's say, having a 3-month bill and rolling it over for 10 years, if you buy a 10-year bond, you now need some more term premium. So the term premium should go up. And let's actually have a look at that. I think I put it up here. I did put it up. Let's have a look here. So here's the term premium. So what you can see here is that on this daily chart, it's actually been rising now for quite a while. So the point is that the term premium is going up now at about 50 basis points or so, and that's going to put added pressure on the curve. And secondly, we should have sort of higher nominal yields and higher real yields and probably a steeper yield curve. And if we actually look here at there's the tips here as well, but if you look on the white one here, this is the real yield approximate on the 10-year in the US. And as you can see here, we're now at about 2.15%. So that's over 2% compared to over the inflation rate. Now, if you also look here at, I think I've got the 30-year, this is the 30-year real yield. So you can see here the 30-year real yield is now almost 2.6%. So the thing is that up until what point can the US economy sustain, real yields which are quite restrictive of over 2% on the 10 and 2.6% here on the 30-year yield. I would say that, historically as well, if you look at the 30-year, anything above 3% on the real yield is on the 30-year is problematic for stocks, but also the real economy, because it's just too expensive. If you want to do a long-term project for financing, if you're paying 3% real yield at a nominal of, let's say, 5 or 5.5, that just becomes quite restrictive on economic activity. And so the other thing as well to think about is that the yield curve should be steepening here as the longer term yields sort of go up more than the front of the front of the curve. And the other thing is that currently what's happening in politics in the US is the not the budget bill, but the reconciliation bill. So let's call it a mini budget. And some of the fiscal hawks from the Republicans, they actually voted against it last week. I believe just over the weekend there were negotiations to pass it. But essentially what's happening here is that what the Trump administration wants to do, it's not going to cut as much as they had touted, as much as they had kind of trumpeted everywhere, and they're still going to be spending a huge amount of money. So some of the numbers I was reading over the weekend, talking about trillions of dollars of extra spending over the next 3 to 5 years. So the point is that the deficit in the US, if anything, is probably going to continue to rise rather than getting smaller. So that means more bond issuance, more pressure on the long term. So all that to say that the long end bonds are under a lot of pressure from, Besant's comments, maybe from the real yields going up, from the Moody's downgrade, and from the fact that just from a budget perspective, America is not really going to have a balanced budget anytime soon, maybe never. And Trump, as we know in this recent big, beautiful bill, he's calling it, he wants significant tax cuts, which essentially are not going to be fully funded. And that's going to put pressure on the curve. So just in terms of all of that, just in general, so is that going to lead to an economic slowdown? If that's the case, if we are going to see sort of the real economy, signs that the real economy is slowing down, that data, the weak data, should start to appear soonish. Because we're going to start getting the April, May data, and here we are at May the 19th. So it's going to be interesting just to see what happens. Now, of course, that may not happen. The recent hard data has remained robust, and so if we don't get the U.S. economy kind of weakening due to these possible factors, that's also going to be a different outcome, and we'll probably keep the stocks strengthened. Okay, so let's have a look at a few charts here, see what's going on. Now, again, we've had this reaction overnight. It seems to have calmed down in the last couple of hours. Let's just start with a couple of the yields here. So let's look at, let's say, the 2-year yield. Now, that's the front end of the curve. Of course, so that's going to be less affected by sort of a term premium and whatnot. But what we are seeing here is that the front end of the curve here, so the 2-year yield is going up, and it's now at just over 4% or so. So that could push up. I mean, to be honest, this could push up to 406, or even in an extreme case up to 410. But that's probably going to be the limit. That seems to have been the limit for the recent period here. And we've seen some repricing of the Fed now, just looking just before I'm doing this video, which is about 8 o'clock in the morning as I'm speaking now. The market is now pricing in less than 2 cuts for the end of the year. So there's been a bit of a hawkish repricing here. So that's the two. Now, we don't have any economic data of particular note this week. So, I think really the range here should be, like if there's any sort of weak news, maybe down to, let's say, 391 or so, and just trading in this range here up to about, 406 or an extreme 410. But having said that, if we get much, much higher, sort of up much over these levels at 415, 420 or something, I think that's really got to be the extreme, because that'd be at the Fed funds rate there, and that would essentially be the 2 years saying that there's not going to be any cuts at all. And I think at that point that would become quite attractive at these levels, as I say, anything around about 420, 425 to start thinking about going long on, let's say, the ZT, so maybe call spreads or something like that. If we actually look at the curve, let's look at the yield curve here, the 2s, 10s. As I say, if I can find it, the 2s, 10s. This has steepened. You see it's gapped up overnight. This is a daily chart here, so you can see this is gapped up overnight, and so this is a real possibility here that this could go up to 65 or something like that. And why would it do that? Like if we get sort of weak economic data, that could sort of bull steepen, so the front end yields could come down significantly. Probably not a lot of action on the long end, but if we get weak data, if the weak data does start to appear in the next 3 or 4 weeks, we could get some kind of bull steepening move here, and that could get up definitely in the first rate up to about 65 and maybe even push up a bit higher. On the other hand, if the data remains strong and the labor market remains robust, that could obviously flatten again, and that could at a minimum flatten down to about, so let's say 40 basis points here, and maybe even get down to something like here about 35 or something like that. So it's going to be quite a binary outlook, and again, no main economic data this week. Again, if we look at another yield curve, let's say a bit further out the curve, let's say the 5s, 30s, not a huge amount of movement, probably not in the next week, because as I said, we don't have too much economic data here. But again, it's going to be similar to the twos to tens I was just spoke about. What is kind of interesting is actually the tens, 30s, and you see here that gapped up overnight. It's given back a little bit, but I think really, the pressure on the longer term bonds is where most of the action will be. And again, that's going to be a combination of real yields going up. So if inflation remains just relatively constant, but the nominal yields are going up, that's going to push up the real yields. Part of that also is going to be the term premium. So if the market perceives there is more risk in US Treasuries, it will demand more yield. And so the term premium could go up another 5 or 10 basis points. And we saw at the moment it's around about 50 basis points. So that I think is going to be reflected on the longer end. So that's why it's interesting something, this curve, let's say the 10s to 30s. So both the 10s and the 30s will go up, but I do believe that the 30-year bond yield will go up more. So I do believe that there's a good possibility that this 10s to 30s steepens up to, let's say, about 53 basis points, something like that. Just grab some tea. Okay, so looking at a few other things, just again looking at those yields. So look at the 10s, where could that go? As you guys can see, it's sort of gapped up overnight, and we're now at about 4.5. For sure, this could, maybe even test a bit higher, maybe 4.59, 4.6, something like that. And again, in the 30s, you see same kind of situation. That's pushed up hard. Now, this is a pretty critical point because in the last couple of days, even as recently as last Thursday, it just touched 5%. I was looking at it. Literally, as soon as it touched 5%, there was a big bid in ZB in the 30-year futures. So now we've pushed above that. And as you guys can see here, it's sort of a little bit of a triple top here at about 501. It's come back a little bit, but this is going to be extremely interesting once the bond market, the cash market opens soon, whether that wants to really push up and really start putting some pressure. Because remember, part of all of this as well is that if the bond yield starts pushing up, could we see a Liz Truss moment where the bond market essentially warns the administration, the government, that, hey, they can't just do unfunded tax cuts. And this could put, along with the more fiscally conservative Republicans, a small group of them, could this force Trump and Bessent to actually scale back their sort of ambitions in terms of tax cuts and actually force them to get a bit more serious about cutting the deficit and cutting spending? Now, if that's the case, if there's not going to be as many tax cuts extended and there's going to be less spending, you start to get in a situation there of talking about a less of a pro-growth agenda. So an agenda which is not necessarily anti-growth, but is a lot more neutral and is less pro-growth. And that, of course, has implications potentially for the real economy, which could start to show some weakness. And then, of course, stock prices. So it's all quite connected. And again, as I say, the stock market and the real economy is not going to enjoy real yields getting too high in the 30-year bond, especially, and also the 10-year. So let's keep an eye on these nominal yields as well. All right, so the other thing as well, which is quite interesting here, is if we look at what's happening in Germany. I just want to bring you guys' attention to something. So we're talking about real yields, but if you look over in Germany, obviously the ECB has been cutting quite a lot, and the nominal yields on the 10-year bonds there are not nearly as high as in the US. So this is basically the real 10-year yield here in Germany based on headline CPI, and you can see here that it's only about 30 basis points real yield. So think about that. In Germany, it's only a 30 basis points of real return. Compared to the US on the 10-year, we saw it's about 2.2. So it's a little bit, what's that? That's about 190 basis points, a better return. So it's interesting, people saying that, money's going to go into Germany and there's going to be, money flowing out of the US and how horrible the US is and the US treasuries. But we have to keep in mind that this is a complex situation and it's quite nuanced, because at a certain point, if the US real return is going to get up on a 10-year to 2.5%, and on the 3-year up to maybe 3%, and the German equivalent here is paying only 30 basis points, it still makes the US on a comparative basis quite interesting. Let's just say that, interesting. So it's not all one-way traffic. That's the point I'm trying to make here. And we can see that if we, on the other hand, of course, there probably will be some reallocations because the German bonds are definitely rated AAA. So there could be some sort of asset allocators who need to, do that. And keep in mind, there are some pension funds who are, obligated to invest some of their money only exclusively in AAA rated. So for sure, there could be, over the like a slow drip of money being reallocated out of US a 10 years, let's say, into the German 10-year. But note that it's not paying as much in terms of real return. So that's going to be quite interesting. But there should be some benefits from reallocation there. So just for the moment, I think that the yields will hold stable and quite low on the 10-year, but over time that could change. Let's have a look now and look at the spread between the US 10-year and the German 10-year, which I have, where do I have that? I think I have that here. So this is quite interesting here. So what you're seeing here is that over the last, couple of weeks, but especially let's say over the last, let's say a couple of weeks here, and it's gapping up, you can see that the spread is now moving higher in favor of the US. So this means that the US yield is going up at a faster rate than the German yield. But for reasons I just explained, I just wonder how much, if this might be capped at, let's say, about 2% or so, because at a certain point, investors will note the fact that actually the real returns investing in US 10 years are more than their German cousins. So I just wonder if that can go up too much more. That's an interesting one here. So yeah, so I'm just thinking, on the other hand, what could happen is that if the German yields, just the way these things work, could it be that actually the yield on the German 10-year go up a little bit more, and also, let's say, on the German 30-year, the Buchsel? So it could be that the German Buchsel, the nominal yields go up to, let's say, 3.2, and let's say the German could go up to, let's say, 2.75. They maybe need to go up another, 20, 30, 40, 50 basis points just to make that real yield, equivalent to the US and more attractive. That's interesting just to catch up, because otherwise it'd be too much of an arbitrage. And secondly, as we all know, there's more infrastructure spending and defense spending. So I'm going to be watching these 10 and 30-year yields, and it's my expectation here that the 10-year yield in the German Bund could stabilize for a day or two, but sort of over a multi-month, multi-week time frame, this could go up a little bit more, because there's just too much differential at the moment in terms of the real return. That's definitely something to be looking out for. Okay, guys, so let's look as well some of the other market reactions. We saw the dollar taking a bit of a hit, and we seem to be getting back into that sort of narrative. You see overnight here, this is the dollar index down. And let's just look at some of the other currencies here. You see that the safe havens have done pretty well. So let's just look here. USD CAD, not a huge reaction. But what we have seen is, for example, the Australian dollar going up, about 70 basis points. Keep in mind that we have the Reserve Bank of Australia tonight giving their interest rate decision. They are expected to cut by 25 basis points. And if we actually just have a quick look at the Bloomberg terminal here, we can get the readings on that. So we can see that in Australia here, sorry, I've got these stupid boxes here. But anyway, we can see that, it's annoying. Let me just bring this down a little bit. We can see that they're expected to cut 24 basis points. You can see that here. So that's what is completely expected. So really the issue is going to be whether that's going to be a hawkish sort of a cut. And the idea is it probably will be, because inflation hasn't moderated as much as had been forecast or hoped. So it looks as though the RBA will be cutting tonight, but probably, with a slightly hawkish, don't expect us to do more sort of vibe. But in the meantime, just on the lack of positivity for the US dollar, you see the Aussies also gone up quite a lot. But where the action's really been, you look at the Japanese yen has strengthened a little bit against the US dollar, but really it's the euro here. You see the euro here up sort of 90 basis points, just come off a little bit, and it's just going to be interesting to see here if the euro starts to break out of this sort of flagging formation. And again, part of this, just looking at the safe haven, you also see the Swiss franc has gained a little bit. So not a massive reaction, but are we getting to that point there where there's a sort of a lack of trust in the US dollar, and it's like a sell US assets kind of vibe? Just in terms of where we could get, as I say, we don't have a huge amount of data at the moment, so it looks as though maybe when a trade is bounced off this 100 level, which is the purple line. So could we be trading in this sort of 100 up to 101, 101, probably 90, this kind of range here. Basically, this sort of two between 100 and 102 is probably going to be the trading range for this week. But what's interesting, if we just zoom out a little bit and have a little bit of a think, I mean, what happens if the tariff levels actually don't become super elevated, and the US yields remain, the real yields remain quite high? That in that scenario, I can imagine a scenario like that the US dollar actually doesn't further weaken that much. But in that case, though, if the tariffs are not super low, then you have to ask yourself, how would Trump and Bessent try and get US manufacturing to come back to the US? Because they still have, relatively low tariffs, et cetera, et cetera. In that situation there, you'd have to say that the only real way to reattract sort of manufacturing activity back to the US would be with a weaker dollar. What I'm trying to say is that if the yields don't go down, if real yields remain elevated, that's going to be difficult for the dollar to absolutely collapse. So it's kind of an interesting little conundrum there for the US administration to think about. Uh, just in terms of other stuff to look at, gold just overnight has rallied quite a lot. Interesting that Bitcoin hasn't, but let's just find the gold chart here. So you can see that gold here just on the slightly US weaker dollar, and I guess sort of a safe haven sort of reaction. We have gold pushing up here, but again, just it still has to get through this hurdle of about 32.50. You can see that's the Fibonacci retracement here. So gold, I mean, yeah, it's had a bit of a bounce here, but it's not necessarily going to continue keep on ripping massively. And you can see here it's got a little bit of resistance here at the 20-day moving average and the Fibonacci level. So we'll keep on monitoring that. What caught my attention is that Bitcoin, which some of its proponents talk about being a safe haven, interesting on a weaker US dollar and some kind of sort of risk, I guess you could say, with the Moody's downgrade. Bitcoin actually was sold off quite heavily sort of over the last 24 hours in here, and that could just be a technical thing as well. If you look here, we're getting to the top of the range, which I'll just draw out over here, so you can see that it is getting towards the top of that kind of trading range and recent highs. So just interesting to see whether Bitcoin does hold up here and sort of act as a safe haven. Finally, we want to look at sort of volatility. We can see that volatility gapped up a little bit. And let's just have a quick look here again, just on the terminal, just to have a look at the volatility curve, which presumably has flipped a little bit at the front end. So I'm going to just have a quick look here. Let's have a look. Yeah, so you can see here that the front end seems to have flipped up. This is the spot price. So the spot trading at about 19. It was down in the 17s on Friday, so now into 19. And just interesting to look, let's say, from a day ago. I'm not sure we're going to pick up on this yet. So it's interesting a day ago. So you see that obviously the front, the spot has gone up, but also everywhere has gone up, but also the shape of the curve here. So flicking a little bit into, well, not really sort of a backwardated state, but definitely a little bit of more volatility in that higher vol complex, and of course that's going to put pressure on the stocks. And no surprise that the ES futures are actually they gap down a little bit overnight. They've come back a little bit, but we're seeing that they're down about 1%. We see the Nasdaq futures down 1.5%. So again, I don't expect to have a huge sell-off. We don't have any economic data, but probably also what's not helping the market, as I say, just to repeat, is that Bessent's comments over the weekend in an interview that tariffs could go back to the Liberation Day level if those countries didn't cooperate and were not negotiating in good faith, to use his quote. And just as a reference point here, we see the Liberation Day was the 2nd of April here, and that's when we had that huge sell-off. So I'm not predicting that, simply saying that a little bit of a pause here on the equities could be possible, even maybe down to this cluster of moving averages here. So you've got the 100 and the 200 here, which would coincide with a moving with the Liberation Day. So let's see what happens today. Again, we don't have a huge amount of data, so markets might just trade in a technical sense. What we do have today is we have Trump on a phone call, I believe, with Putin discussing the situation in Ukraine. I don't know how much that's going to affect markets. Possibly, if that's a little negative, that could just add a little bit more negative sentiment. But I think it's a peripheral sort of issue at this point. Let's see what happens there. The other thing I just wanted to mention as well, just in terms of the equities, I didn't discuss, but I just wanted to quickly throw that up here. If we look at a general equities fund, something like GSG, whoops, GSG. Yeah, just interesting to note, just from a slightly longer term perspective here, just that we're still in the middle of the range. So this is a daily chart going back a pretty long time here, going back, like a year or two. And you can see here that, all the moving averages are pretty flat, if anything, sort of heading downwards. And it's just interesting that with a sort of weaker dollar, sticky inflation, it looks to me like, like these rallies are not, any rallies not really being sort of continue supported. So it's just interesting that even last week we had some quite positive vibes, not so much obviously over the weekend, but last week with the positive vibes, we had the equities going, moving up very strongly and whatnot. Just commodities, just finding it very, very difficult here to get out of the middle of the range. I mean, they're not collapsing, but they're not pushing up towards the top of the trading range. And I just wonder whether this is signaling some kind of lack of confidence, at least in the commodity market, about the global economy. It's just interesting to keep an eye on that. Something like one of these general ETFs like GSG, and if you look at something like copper, I mean copper has its own issues in terms of specifically China and the COMEX warehousing and whatnot. But just also a similar kind of situation in copper here. You see that it's just finding it very difficult to rally. And keep in mind this very tight kind of sideways consolidation which we had last week. Keep in mind what was happening in some of the other risk markets, like the equities, which were actually pushing much higher. Just to remind ourselves, just looking at equities last week, boom, you see this is what equities did. But copper and the commodity space in general, very, very flat. So there seems to be a little less confidence in those markets that the global economy is about to continue sort of expanding at a solid rate. Okay, I'll leave it there. I've spoken too much. Have a wonderful day, a wonderful week, and we'll keep the conversation going. Thank you.